morning and welcome to the spring meetings. This is the Global Financial Stability Report press conference, and I am Randa Naggar of the IMF Communications Department. We have with us here Financial Counselor for the Monetary and Capital Markets Department and Director of the Department, Mr. Tobias Adrian. We have with us Deputy Director of the Monetary and Capital Markets Department, Fabio Natalucci, Division Chief for the Monetary and Capital Markets Department, Ana Elena, and Mr. Benson Durham. He's the advisor to the Monetary and Capital Markets Department. Tobias is going to give some opening remarks, and then we're going to take your questions. Thank you.
Good morning. As the World Economic Outlook noted yesterday, the global economy continues to show broad-based momentum. Today, I will discuss our outlook for financial stability. Since our last Global Financial Stability Report, short-term risks to financial stability have increased, and medium-term risks remain elevated. Despite the VIX tantrum in February, the recent volatility in equity markets due to trade policy tensions, still easy financial conditions continue to support global growth in the short term. But there has been a buildup of medium-term vulnerabilities which have accumulated during years of low interest rates. Vulnerabilities may make the road ahead bumpy and could put growth at risk. Our growth at risk analysis, which links financial conditions to the distribution of future global growth, indicates that under a severely adverse scenario, growth could be negative 3 years from now. This report discusses 3 main vulnerabilities: stretched valuations across many asset classes, borrowing by emerging markets in low-income countries, and bank dollar liquidity mismatches. I will discuss each of these 3 vulnerabilities in turn. The first vulnerability is that valuations of risky assets are stretched across many markets. Some late-stage credit cycle dynamics are emerging. Corporate bond spreads remain at low levels, issuance of riskier bonds has surged, and leveraged lending hit a record high in 2017. A faster than expected pickup in inflation might lead to a more rapid withdrawal of monetary accommodation by some central banks. This could trigger a sudden tightening in financial conditions and a sharp fall in asset prices. The resulting turbulence in financial markets could be amplified by liquidity mismatches and increased use of financial leverage. The second vulnerability is that emerging markets in low-income countries could face a sudden tightening in global financial conditions. Such an event could lead to a reduction in capital flows. Debt sustainability in low-income countries has deteriorated, and a more complex creditor composition poses challenges for any future debt restructurings. The third vulnerability is that there's a structural US dollar mismatch among non-US banks, even though banks overall have improved their resilience in the global financial crisis. The international US dollar balance sheets of non-US banks rely on short-term wholesale sources for about 70% of their funding. This could leave banks exposed to dollar funding problems in the event of strains in markets. The report also looks at crypto assets. Some of the technologies behind crypto assets could make the financial market infrastructure, such as payment systems, more efficient. But crypto assets also have been afflicted by fraud, security breaches, and operational failures. The limited size, now around 3% of combined G4 central bank balance sheets, currently implies little risk to financial stability. But they could pose greater risks in the future. This all suggests that policy actions are needed in several spheres. Central banks should continue to normalize monetary policy gradually, and they should communicate their decisions clearly. Regulators should address financial vulnerabilities by deploying and developing prudential tools. Policymakers should ensure the post-crisis regulatory reform agenda is implemented, and they should resist calls for rolling back reforms. To sum up, the economic recovery has remained resilient despite market volatility. But investors and policymakers should not take too much comfort from today's relatively easy financial conditions. They should remain attuned to the risks associated with rising interest rates, elevated market volatility, and an escalation of trade tensions. The road ahead may well turn out to be bumpy.
Thank you, Tobias. We're ready to take your questions. Please identify yourself and your organization. Sir, in the second row.
Alex Brummer, Daily Mail. In the past, you've identified problems with non-performing loans in the European banking system. I wondered if you could enlarge on where that's got to now, what the scale of the non-performing loans is at the moment, and whether you're seeing any progress.
There is some progress in terms of non-performing loans as the economic recovery is strengthening, but the overall level of non-performing loans remains high in some countries, and more progress is needed to ensure financial stability going forward.
So just to actually, Tobias, so the idea essentially there's a need for comprehensive strategy here. So some step has been taken by national authorities, banks themselves have taken steps. Of course, growth helps as the economy recovery goes. That helps bring down the level of non-performing loans. There's proposal at the European level, so the European Commission action plan, there are guidance from the ECB, and then the comprehensive strategy obviously needs to include also steps toward simplifying the judicial system, so more expeditious resolving of non-performing loans, as well as develop the secondary market for banks to dispose of those loans. I believe we have a chart in the report. It should be 900 billion, if I remember correctly.
Thank you. Yo-Yo from Hong Kong Phoenix TV. You mentioned trade tensions in your remarks. I'm just wondering what kind of risks do you think a trade war between U.S. and China will impose on the financial stability of the world? Thank you.
In the press conference by the Economic Council yesterday, there was extensive discussion of trade issues. Here we're focusing on financial stability implications of trade tensions. What we have seen in recent weeks is that the discussions around trade and actions taken around trade policies have increased investor uncertainty. As a result, financial conditions have tightened somewhat, but overall remain easy. So the main effect that we have seen so far is an increase in uncertainty in financial markets.
The gentleman in the fourth row.
Howard Schneider with Reuters. Two questions, if I could. One, you mentioned resisting calls to roll back regulations. I'm wondering if you've had any sense of the steps taken in the U.S. so far and proposed by the Trump administration regarding changes to the Dodd-Frank law, and whether that rises to the sort of critical level of that you think could pose problems down the road. And then secondly, if you'd elaborate a little more on inflation, I was sort of surprised to see that come up. I don't think that's on the radar of any major central bank in the world right now. And it seems to imply that this would have to happen to be a problem, A, globally, and B, would have to also involve a policy mistake of some sort on the part of those central banks to turn it into a financial risk. So if you could maybe attach a probability to that actually happening.
So let me address the question about regulations. Since the global financial crisis, regulatory reforms around the world have made the financial system safer. Capital and liquidity buffers have strengthened, and resolution regimes have been introduced around the world. We feel that these are very positive steps. Jurisdictions around the world are taking steps to evaluate any unintended consequences of these regulations on market functioning and on credit availability. This is done under the auspices of the Financial Stability Board. And as jurisdictions look at any of these unintended consequences, there might be some adjustments to the regulations as they were implemented in recent years. However, we would warn against any rollbacks of the overall level of capital, the overall level of liquidity, or any rollbacks in terms of the resolution authorities.
Yeah, so the only point I would add that Tobias mentioned, under the umbrella of the FSB, I think it's an important point to the extent that we need to tweak, there's a need for tweaking regulations at the margin, and that there's the fact that it's done at the FSB level, so at the international level in a coordinated manner, what is international cooperation essentially, that helps to look, keeping the level playing field, avoid regulatory arbitrage and so on. So that's an important point.
So let me address your question about monetary policy as well. What we're flagging in the report is that uncertainty about inflation is very low at the moment, right? So analysts and investors agree that inflation will likely be low going forward, below target in many jurisdictions. What we're flagging is that at some point we might well see shocks to inflation that might increase inflation uncertainty. And historically, when inflation uncertainty increases, that is associated with a rise in long-term interest rates. And that might lead to a sharp tightening of financial conditions.
Gentlemen.
Morning, Ricardo Leopoldo, Agência Estado do Brasil. Mr. Adrian, could you comment a little about, in a case that the monetary policy in the United States faster the pace, more than expected now, in the short run, what would be the major risks for the financial stability worldwide?
So the scenario, one of the scenarios that we consider in the report, it's where there are stronger than expected print in inflation, for example, or there's a repricing on inflation rates in markets, and that brings the central banks to accelerate the pace of normalization, and that would bring in a tightening of financial conditions. That would have implication for both other central banks. They are either starting to normalize or gearing up to normalize. We look at correlation of yields across major advanced countries, and we see that correlation has increased, so that could have some spillover effect in other advanced countries, as well as implication for emerging markets. A tightening of financial condition will probably affect the inflows, or to generate the reversal capital flows that we have seen over the past few years. So it could have spillover effect both in other central banks in advanced countries as well as in emerging markets.
The gentleman in the first row.
My name is Obin Nachima from This Day in Nigeria. What were the specific findings about Nigeria? And I would like to know if you are comfortable with the stability we've seen in the Nigerian foreign exchange market, and if you are okay with the measures taken so far by the Central Bank of Nigeria. Thank you.
So we don't go into the details of specific countries in the report. There will be a regional press briefing on Friday that is looking more specifically at different regions, in particular at sub-Saharan Africa, and specific country questions can be raised at that point. In general, what we see in many emerging and low-income countries is that debt levels are rising and that underwriting standards of foreign debt are deteriorating, and that is a risk for financial stability of those countries.
Please, the gentleman.
Good morning, Ferdinando Giuliano, Bloomberg View. I have a question about crypto. In the report, you just seem to essentially observe that there is a variety of approaches to regulations which have been taken around the world, and that this can be quite different. So I was wondering whether you have a preference over the different models. And I'm also asking because you call for greater harmonization and coordination, and it seems to me to be quite different to have that coordination if countries go with very different models on approaching this subject.
Absolutely. So what we see at the moment is a wide variety of approaches to the regulation of crypto assets. What many jurisdictions are doing is to apply existing regulations to this new and emerging sector, and that is yielding some results across jurisdictions. What is important is that regulatory approaches are taken that are generating trust in emerging technologies. We have seen a number of cases of fraud and operational failures in this new and emerging sector, and that is, of course, negative for investor confidence and consumer confidence. Furthermore, we feel that cooperation across jurisdictions is important, as investments in crypto assets is very global by nature, and business models in the fintech sector are very often very global by nature. So some coordination across jurisdictions is important. At the same time, we do note in the report that the sector remains fairly small at the moment, so it doesn't represent a major financial stability risk for the moment, but that might change going forward. So remaining vigilant and really understanding what is happening in the fintech sector and with emerging technologies in the financial sector is a priority for regulators.
The lady in the back, please.
Hi, good morning. Estelita Carazai from Brazilian newspaper Folha de São Paulo. I know you haven't addressed this in the report, but we have upcoming elections in major countries, major economies this year, like Brazil itself, Mexico, India, the US itself. I was wondering if this is also an issue for financial stability, and how do you face these upcoming elections? Thank you.
So policy uncertainty is certainly a driver of uncertainty in financial markets. We have seen a gradual increase of financial market volatility from very low levels last year to somewhat more average levels this year. And uncertainty about policies is one of the drivers of this development.
One thing that is worth pointing out is that many of the major emerging markets countries have benefited from very favorable external financing conditions. That also created some room for them to strengthen their fundamentals. Many of the EMs, largely emerging markets, including Brazil, have managed to narrow their current account deficits, which puts them in a stronger position to deal with any kind of external shocks. But of course, as Adrian mentioned, Mr. Adrian mentioned, policy uncertainty does create additional volatility. And we have indeed seen some increased volatility in major EM currencies lately. But of course, this could also be related to other sources of uncertainty globally.
If you don't mind, we're going to go online. We have a few questions. We have one from Sina in China. How do you evaluate the deleveraging process in China at this time? Is China improving compared to last year?
Yes, thanks very much. In China, regulators have taken decisive steps to tighten the regulatory environment. These steps are very welcome by the IMF. We had a financial sector assessment program in China that concluded last year and that recommended the tightening of regulations. What we see so far is that the rise in debt levels has slowed down in China. However, the overall level of debt remains fairly elevated in China, and so we would welcome further regulatory tightening going forward.
So Chinese authorities made financial stability a top priority and have taken important steps to address financial stability risk as well financial vulnerabilities, taken on board key recommendations for the FSAP, and so we welcome these steps. There are, of course, a number of factors and risks that need to be addressed. One of them is like non-regulatory factors, for example, so growth target, which have implications for credit growth and leverage in the system. The report looks at the interconnectedness and opacity and complexity of the financial system, so the interaction between the banking sector and the shadow banking. And so the assessment in terms of the deleveraging of the financial system is that they're taking important steps. They are going in the right direction. There's more that needs to be done. An important element also we highlight in the report is the existence of implicit guarantees. And so it's important that authorities prioritize strengthening the policy framework and the position, capital and liquidity position of institutions so that do not inadvertently bring forth a financial stability risk. And so the sequencing at pace of the reforms and steps taken by the Chinese authorities is crucial here.
Thank you. We're going to go online again. One is, to what extent might shadow banks amplify any turbulence in markets? This is from Central Banking Publications in the UK.
Yes. The shadow banking system has become safer since the global financial crisis. 10 years ago, shadow banking was one of the major contributors to the turbulences of the 2008-2009 global financial crisis. Since then, steps by regulators in the banking system have been taken to sever the ties between the banks and the shadow banks, and that has been successful in many jurisdictions around the world. As a result, we have seen more and more of an emergence of the market-based financial system, which is generally less levered than the shadow banking system from 10 years ago. I would point out, however, that shadow banking in China remains prevalent and that it is a large fraction of the financial system there.
Check in the room. Sir.
Seni Marena from the Gambia Radio and Television Services and also IMF Journalism Fellow 2018. Thank you. My question is, what impact will this global stability report will have on Africa with regard to the fight against corruption? Thank you.
The Global Financial Stability Report does not specifically focus on corruption issues. Of course, corruption is an important consideration that the fund is addressing in other publications. And, you know, there is some link to the accumulation of debt. We do see that in some African countries, debt is accumulated quickly, and that could pose financial stability problems for those countries in the future.
We have one more online, please. It's from Egypt, asking about, the question is about digital currencies, pros and cons, and how can they help emerging economies such as Egypt?
There is an emergence of digital currencies around the world. There have been over 1,000 initial coin offerings that have occurred over the past 2 years. And this emergence of new currencies might well shape the nature of the financial system going forward. Today, it is difficult to say how exactly these new developments are going to shape the financial system, but there are potential benefits. So one potential benefit is on the cost of international payments that might go down in the future at some point, but it's too early to say whether this is really going to take place.
Further questions? Yes, sir.
Morning. My name is Chris Chenga. I'm from Zimbabwe. I'm an IMF fellowship journalist. In terms of your Africa Outlook debt, there's a fiscal multiplier, which the IMF recently started recommending, which basically traces the impact of fiscal decisions. Now, is there a more precise way in which the IMF can recommend and trace numerically with facts and figures the debt utility? Has these countries utilized the debt that they get from the IMF?
So the IMF is working with country authorities on evaluating fiscal policies, including on estimating fiscal multipliers. That again is the subject of the regional economic outlooks as well as the fiscal monitor. So the fiscal monitor is going to be discussed in this room next, and the regional economic outlooks are going to be discussed on Friday.
Let me just add a couple of things. I mean, we certainly are very much focused on public sector debt dynamics in low-income countries. And there's been a rapid accumulation of public debt in the last few years. In fact, the median public debt to GDP ratio in low-income countries rose by over 13 percentage points to about 47% of GDP, which is quite a dramatic increase in such a short period of time. Also, this leads to difficulties for some countries in managing and servicing this debt. In fact, over 40% now of low-income countries are at high risk of distress, and this is up from about 20% in 2013. It's also a rapid increase, so we certainly are very much focused on this. From the point of view of our report, we do track the debt issuance by low-income countries, and we've seen that there was again a strong rebound in international bond issuance by low-income countries, by frontier markets last year, and even early this year, despite global market volatility, issuance has been strong from several countries from the region. And the IMF, of course, is trying to provide some technical assistance to these countries on sound debt management, as well as on how to make sure that they can keep track of all the sort of borrowings and there are as few as possible data gaps, so different ways of addressing data gaps. And also the IMF has recently rolled out the new debt sustainability framework for low-income countries that should help identify more precisely the sources of different debt-related vulnerabilities.
Thank you. Also, I just wanted to apologize. Perhaps I didn't put it in a global context, but it is a global context. Why? Because developed countries are affected, and most correspondent banks that attend to developing nations are from developed countries. So I just wanted to bring that context. Wasn't meant for low income. It's a global issue as well.
Yeah.
So in terms of correspondent banking, we have seen a withdrawal of correspondent banking from some jurisdictions. The fund is working with our membership on addressing a number of AML, CFT shortcomings. And that is starting to show some success in certain jurisdictions. So the number of correspondent banks has actually increased in some countries. And more generally, the withdrawal of correspondent banking has slowed down in recent months. So it's an issue that we're very focused on and that we're monitoring with great detail, and we do work with our membership in a very intense fashion.
Further questions? Sir.
Sorry to ask a second question. Alex Brummer from Daily Mail. I was going to address the Brexit and European Union, just one issue in particular. There's been a lot of concern that most of the euro clearing is done through London at the moment, and that other jurisdictions across Europe might want to take some of that clearing, and that might weaken the supervision and regulation of and safety of those clearing systems. And I wonder if you had any thoughts on that.
So derivative is one of the issues that, of course, we pay attention to, and it could be related to possible financial stability risk as it relates to Brexit and whatever long-term agreement is reached. The long-term solution at this point, I'm not going to speculate on what the optimal final solution would be. I think an important point to make here is that to manage financial stability risk associated with clearing derivative position, it's very important that cooperation between regulatory authorities on both sides, so the UK side and the European side, that level of cooperation remain high, so that financial stability consideration brought into consideration to the extent they reach a final agreement.
Yeah, let me just add to that from a policy point of view, since the global financial crisis, there has been a push by regulators to centralize clearing, and so around the world we see that in different security markets, we have seen an increase of clearing in different CCPs, central clearing counterparties around the world. And so, within the Brexit negotiations, there might be a push to decentralize some of that clearing. So from a policy point of view, there are trade-offs on the one hand between the efficiency and the financial stability benefits from centralized clearing, and on the other hand, having a more direct regulatory control over your own jurisdiction.
Please.
I'm Maria Saturan from Ukrainian news agency RBC Ukraine. You mentioned in the report that one of the risks crypto assets markets. Do you have some advice for financial regulators of the countries how to react on the cryptocurrency expansion? Is there any traditional regulational methods that could be achieved in this situation? Thank you.
So a number of existing regulations can be applied to crypto assets. Consumer and investor protection laws that are existing should also apply to crypto assets, and security market regulators in many jurisdictions are enforcing those regulations to crypto assets. Furthermore, there are some infrastructure concerns about crypto assets. We have seen a number of issues relating to operational failures and fraud in markets around the world, and different jurisdictions have addressed that in a variety of ways. In general, we do recommend a cooperative approach to regulatory actions.
Okay. Thank you very much. We'll take one last question and then wrap up.
Okay, Onyewak of Business Hallmark from Nigeria. In which jurisdiction do you expect more of the envisaged negative growth in 3 years' time? Thank you.
So in the report, we are looking at financial stability risks 1 year and 3 years into the future. And what we are showing is that in the short term, so at a 1 year horizon, financial stability risks have increased, but they remain fairly low. In the medium term, at the 3-year horizon, financial stability risks are elevated, and that is because vulnerabilities are building in an environment of easy financial conditions. So our estimate of global growth in a severely adverse scenario, so if negative shocks realize at a horizon of 3 years into the future, if negative shocks realize, we do expect in an adversely in a severely adverse scenario to have negative growth in the future. And different countries are going to be exposed to such a negative scenario in different ways. And that really depends on the buildup of vulnerabilities in countries. So countries that are building up higher debt levels, that are exposed more to currency mismatches and liquidity transformation, are going to be exposed more to any adverse developments in terms of global financial conditions.
Okay, thank you very much for coming. Thank you to Tobias and the team. We have the fiscal monitor later, so please come back for the press conference. Thank you.